Hey everyone, it's Julie here with TipRanks, and today we're taking a look at two industrial stocks with buy ratings from a top analyst. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at a couple recent buy ratings from an analyst that is ranked the very top of his sector, which is the industrial sector. We're going to take a look at these companies, what it is that they do, and of course how this analyst and others are weighing in on the stock's future. Now we came across these using the top experts page over on TipRanks. Under top experts, we're taking a look at Wall Street Analysts, and in one of the top positions here, we have Brown of Raymond James. He's currently ranked number 2 out of over 9,000 Wall Street analysts with a 75% success rate over the past year and 83% success over the last 2 years. He covers the industrial sector in both the US and Canadian markets. Just before we jump into a couple of his recent buy ratings, this is a reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Now let's take a look at our top analysts' recent buy ratings. First up is a company that is fairly new to the public markets, that is Proficient Auto Logistics. Trading under the ticker PAL, they're currently priced just shy of $18 per share. They began trading in mid-May and have grown 19% since. The company had an interesting IPO. Part of the deal was that they were acquiring 5 different operating businesses to combine into one public entity. And through the combination of these industry-leading operating companies, they now operate one of the largest auto transportation fleets in North America, utilizing roughly 1,150 auto transport vehicles and trailers on a daily basis. They have over 50 strategically located facilities across the United States, offering a broad range of auto transportation and logistics services, primarily focused on transporting finished vehicles from auto production facilities, marine ports of entry, or regional rail yards to auto dealers across the country. About a month ago, on August 9th, the company shared their second ever earnings report as a publicly traded company, coming out with both an earnings and revenue beat. They reported Q2 earnings per share of 28 cents, beating expectations by 8 cents per share, and total operating revenue came in at $106.6 million, which did beat by nearly $5 million and also increased 5.8%. Their CEO said that they produced strong operating results during the second quarter in spite of weakening customer demand during June. They also announced a new acquisition, saying that they were pleased to be adding what is essentially a 6th founding company to the organization when they close on the purchase of Auto Transport Group during the third quarter. Our top analyst, Brown, recently increased his price target on the stock, saying that Proficient Auto Logistics represents a unique opportunity in the transport complex to leverage a recovering auto market, declining union carrier share, and benefit from a number of internal self-help initiatives. The auto hauling industry has higher barriers to entry versus truckload, and recent woes in the auto market may set up for the auto hauling industry for an idiosyncratic pricing cycle. We also had a 5-star analyst from Barrington reiterate their buy rating. They noted that Proficient is a leading non-union specialized freight company focused on providing auto transport and logistics services, and that the stock's discount to peers will dissipate as Proficient executes its growth strategy and its margins expand as expected. Now, this new kid on the block has only attracted 4 current analyst ratings, but does come in as a unanimous strong buy. And the average price target of $21.67 implies an upside potential of 21%, and our price targets are very close together here, ranging from $21 to $22 for an upside of 17 to 22.5%. The second stock recently picking up a buy rating from our top analyst is Construction Partners. They trade under the ticker ROAD, or ROAD, currently priced at $56.98. Their stock has climbed 64% over the last year, and in the last 3 months has gained almost 5%. Aptly named, the ROAD stock engages in the construction of roadways and highways. They are a vertically integrated civil infrastructure company operating across 6 southeastern states. Supported by their hot mix asphalt plants, aggregate facilities, and liquid asphalt terminals, the company focuses on the construction, repair, and maintenance of surface infrastructure. Publicly funded projects make up the majority of their business and include local and state roadways, interstate highways, airport runways, and bridges. They do also perform some work in the private sector project, including paving and site work for office and industrial parks. They shared their Q3 earnings report on August 9th, where they had both an earnings and revenue beat and increased their future guidance. Their Q3 earnings per share came in at 59 cents, beating expectations by 5 cents per share, and revenue came in at $517.8 million, which did beat by over $13 million. It also grew over 22% year over year, while net income was up over 42%. The company had record backlog of $1.86 billion. Looking forward, they increased their guidance for fiscal 2024 in regard to revenue, net income, adjusted EBITDA, and adjusted EBITDA margins. And once again, our top industrial analyst from Raymond James did increase their price target on the stock, saying that the benefits of organic and external growth opportunities set the stage for upside to numbers in out years for construction partners. A clear inflection of margins that started in fiscal 2023 continues to take hold with momentum in 2024. We also recently heard from an analyst at D.A. Davidson. Now, they did maintain a hold rating on the stock, but increased their price target. They said they're encouraged to see continued margin expansion and improving ROE, while also citing the company's favorable public markets and planning that is still supportive of future growth. They raised their fiscal 24 earnings per share view by 6 cents and 2025 by 7 cents. With 5 current analyst ratings, the stock does come in as a moderate buy with 3 buys and 2 holds. And the average price target comes in at $65.50, implying an upside potential of about 15% from current prices. Looking down below, on the low end, we do have that hold rating here from D.A. Davidson with a downside of about 3.5%, while our top analyst at Raymond James is our high-end price target at $72 for an upside of 26%. So that is a quick look at 2 stocks in the industrial sector with recent buy ratings from a top-ranked analyst. Let me know your thoughts on these companies and whether they were on your radar or not, or what other stocks in this sector have you excited. I always love hearing from you guys. Please keep in mind these videos are never a suggestion to buy or sell any specific stock, so make sure you always do your own due diligence and research. Thank you guys so much for watching. Have a wonderful day, and I'll see you back here next time.